This is the video for our first brunch at the markets that happened live on Ustream earlier this morning. We'll skip the usual self-promotion so we can get right to it. So that means you have to visit the website at magnumopussfinancial.com and poke around on your own. Bank of America, $15 is your bogey. Karen Feinerman has been a fan of this company for months and months. We saw her live in Philly at the Invest Like a Monster conference we brought you live on Twitter, and even in person, she was still talking Bank of America. I think the only thing that's changed now is the top of the range for Bank of America has become. I won't lie, there are concerns about Bank of America considering credit card charge-offs and, of course, foreclosures. Expectations for Bank of America are much lower now than they were even 45 days ago. $20 may still be the level that you at least want to trim much of your holdings. Luckily, when this stock was still over $16, we told you you were trimming to get ready for this pullback that we've now had. Fundamental story remains intact. This bank will bank when earnings are more normalized, and we think you should own it, especially below $15. More than just Karen Feinerman on the desk last night said you can get long here. We agree. Okay, Chesapeake. The only real controversy regarding this stock is about Aubrey McClendon's pay package from last year. Honestly, we've heard plenty of that regarding Goldman Sachs and at Chesapeake. At least it's only one person and not 20 or more. We also let you know on this one, when the stock got down to $22 and change, that we were building our position over here in the natural gas name. Also, we wrote the plan for sustainable economic growth, in which we lay out the plans for natural gas. You can find it at www.magnumopussfinancial.com/energy to read the entire plan. You have to go directly. You can't find the plan any other way on the website. We're tricky like that. So why Chesapeake? It's a natural gas company that is the most levered to the price of natural gas. And as Jim Cramer pointed out last night, it's the only company that looks most like XTO Energy that was bought by Exxon this week. Hopefully that deal closes. Environmentalists are crying are crying over the water table with fracking, but this is an actual technology that brings a cleaner fuel to market, unlike clean coal, which is a myth. Let us point out that using coal really is a lot cleaner these days than it has ever been in the past. It's just the idea of quote-unquote clean coal that doesn't actually exist. So like Jim Cramer said, don't buy the company just based on takeover possibility. You need to own it, even if that never happens. Chesapeake is that company, and until it gets back to $28, which is where it was before it jumped off a cliff to $22, you can buy it. Past that, you have to decide. Finally, Gilead. This company is the strongest HIV franchise around. Just recently had a drug flop, the phase 3 trials, and they abandoned it. Look, to be honest, the sales of the drug were not even factored into the earnings. So except for the fact there will be no surprises to earnings from this drug, the story is really the same for Gilead. Except now you can grab the stock for $43 and change, and we think you should. The 52-week low is only $41, so you're pretty much there. Very little downside and about $10 worth of upside just to get back to the 52-week high, and we think this company can still grow. It may even be acquired. Now that would be big, but own it just to own it for right now. Let the takeover stuff be what it may, and get long some GILD. Okay, we had some requests, so we'll cover those really quickly, as we haven't followed these names longer term, so it's tough to do anything but quick analysis of the names. But you asked, so we'll deliver, and here you go. GDP, Goodrich Petroleum Corporation, no current or forward-looking PE. That's scary, as it means terrible margins. ROA and ROE are negative, and it looks like revenue growth is negative year over year. The debt to cash is only 1 to 3, so it's not levered massively, but the levered free cash flow is negative $257 million, so look elsewhere. If you'd like to cheaper play, go with WFT, Weatherford International, which is still levered, but it's got a PE that trades at 18 times earnings and still is valued at $6 billion under its enterprise value and has really lagged the space so far this year. CRM, Salesforce.com, stay away. This was something you could own a few months ago. Honestly, it has a PE of 110, and that's just insane for us. Too much risk of multiple compression on the exact same earnings. Not saying it's a bad company, but it trades above its enterprise value. On the plus, it is a great company and barely has any debt. For companies like this, Amazon, Goldman Sachs, if you want to own them, they're great companies. Just use the January 2011 leap call options as a realistic strike price. Like for $10, you can get the January 2011 70 strike price. It's only $5 from the current levels that should give you plenty of upside should the story continue through 2010. If not, you're only out $1,000. You'd be able to sell the call anytime before the date, but if the stock tanks, you'd have a max loss of $1,000, which isn't that bad. AMN. I really like this company. It does water infrastructure as well as transportation and energy infrastructure. I'll have to jump on the next conference call to see what their domestic or international mix is. But it looks really attractive. $18.47 a share of cash on hand. Love that. It pays a dividend. Love that. Has a great free cash flow, reasonable PE, 15.5. Little concerned that the market cap is so much more than the enterprise value, and forward PE is 16.5, which means lower earnings going forward at the same stock price. That could be a negative, but the stock is not at the top of its range. Its 52-week high is $91, so if they just grow like they have before, they can get back there. It was in September and not last January, so it's a good sign. It must have had a bad quarter or something along the way, so under $65, take a shot. Finally, WDC trades at 17 right now, but forward PE is 8.8. That means earnings will rise dramatically. $9 a share in cash is fabulous, and they're growing earnings and revenue. Do it. Can probably buy it here on a pullback, build your position. The company looks fabulous, pretty much at 52-week high, but the future looks bright. Hope this was good for you. We enjoyed putting it together, a little crazy and hectic, but that's the market. Have a great quadruple witch out there, and we'll see you next week. Don't forget to check out the other YouTube videos. Go to MO Financial on YouTube, or go to the homepage at www.magnumopusfinancial.com and click on the TV station on the MOF News Network.